This webinar focuses on key global macroeconomic trends in December 2012. Sovereign debt crisis has remained a major macroeconomic challenge in 2012. There was a wave of political brinkmanship over sovereign debt problems in Europe as well as the fiscal cliff in the United States. Ironically, the macroeconomic instability could not deter the rebound of global equity markets, which have generated positive returns since 2012. The S&P 500 index recorded a stellar performance of 16%, primarily driven by strong fundamentals taking position in the US economy. It is noteworthy to state that the US housing and job markets have shown significant improvements, thereby improving the consumer confidence. On a similar note, in Europe, the German, French, and even Greek markets have shown amazing performance in 2012. It looks like that positive expectations about future outcomes in Europe and the US have weighed heavily on the directions of their respective stocks markets. In comparison to the US and European stock markets, the Canadian stock market has underperformed in 2012. The S&P TSX Composite Index registered a mediocre return of 4% mainly because of slumping energy and materials sectors, which had minus 3.6 and minus 6.9% year to date returns in December 2012. Paradoxically, gold and commodity stocks have performed worse than their underlying commodities. Further, there are signs of softening of the Canadian housing market amidst risks of rising debt to income ratio of Canadian consumers. The 2013 outlook points to some degree of volatility due to fiscal cliff and European debt issues. The Chinese manufacturing is in the positive domain and the US fundamentals will trigger further surge of the S&P 500 index. The key question is what will be the threshold point of volatility which will not deter the investors from taking positions in the capital markets? In either case, the prices of commodities and yields of blue chip stocks and corporate bonds are expected to remain robust through 2013. The key driver of commodities will be the Chinese growth, while the yield on blue chip stocks and high quality corporate bonds will be driven by increasing premium over highly depressed interest rates.